1 minute smarter, every market clearer. Welcome to my channel, I'm Claire. Welcome back to my channel. As an independent researcher who has long observed the shifts in the tech industry, I've been reflecting on a specific question. Why is it that, in an era of such high information transparency, the top elites on Wall Street still suffer from a collective misjudgment of obvious trends? If we take a close look at the recent volatility in tech stocks, you'll find a truly fascinating phenomenon. Dan Ives, a veteran analyst at Wedbush Securities, recently proposed a provocative idea he calls Wall Street's collective cognitive sluggishness. Interestingly, the data shows that despite being surrounded by AI news every day, only 3% of enterprises across the US have actually started the process of AI integration. I believe there is a massive cognitive gap hidden behind this figure. If you're in Silicon Valley or follow tech media closely, you might feel that AI is everywhere. However, this is a classic information cocoon effect. In reality, the demand from that remaining 97% of enterprises is like a tsunami gaining momentum in the deep ocean. It hasn't reached the shore yet, but its energy has already gathered in the depths. This current state of affairs means that the AI boom we see today is, in essence, still just an elite club party for a select few. Who are these early movers? They are the giants at the top of the pyramid, the big tech firms, top Wall Street investment banks, deep-pocketed hedge funds, and a handful of sharp-eyed biopharmaceutical companies. They have the deepest cash flows. While average companies are still hesitating over whether to try an AI subscription, these giants have already bought out the first batches of NVIDIA chips. But I think the more interesting observation lies in that overlooked 97%. These companies form the capillaries of the American economy, mid-sized manufacturers, state healthcare systems, thousands of law firms, and traditional insurance and logistics companies. I've found that these businesses aren't avoiding AI. Rather, they are in a state of watchful anxiety. Take healthcare systems, for example. They are desperate for AI to handle massive medical record analysis and diagnostic assistance, but the barriers of compliance and privacy haven't been fully cleared yet. Or the legal industry. While document review and case law research are high-demand areas, vertical-specific fine-tuned models haven't yet launched on a large scale. This is exactly the starting point of the demand curve that Ives predicts. When these second-tier players and traditional enterprises begin to enter the market out of a fear of missing out, just to survive, the current supply gap will seem insignificant. Let's turn our attention to specific giants, particularly Microsoft. Ives gave Microsoft a very interesting nickname, the Rodney Dangerfield of the software world. This late comedian's most famous line was, "I get no respect." You might think that sounds absurd. How can Microsoft, one of the world's most valuable companies, get no respect? In reality, this disrespect shows up in Wall Street's valuation logic. I've noticed that many analysts currently lean toward the view that Microsoft's AI story is already told, and that all the good news is already baked into the stock price. But interestingly, data shows that over the past month, the growth rate of Microsoft's cloud service, Azure, unexpectedly accelerated by 25% to 30%. Note that this isn't just maintaining growth, it's a reacceleration on an already massive base. This momentum isn't coming from traditional storage services, it's driven directly by explosive AI demand. The general consensus on Wall Street is that Microsoft's growth will level off by fiscal year 2026, but Ives points out that these forecasts underestimate growth potential by at least 15% to 20%. To understand this undervaluation, we need a deeper sense of history. Think back to 2014, when Satya Nadella first took over Microsoft. Wall Street was full of doom and gloom, believing that Amazon's Oz had already won and that Microsoft, a laggard with heavy enterprise DNA, was destined to fail. The result? Azure became the most powerful profit engine of the last decade. I see the current AI revolution as almost a carbon copy of the 2014 cloud transformation. Once again, analysts are staring at short-term ROI, complaining that Microsoft is spending too much on GPUs, while ignoring that Microsoft is redefining every single workflow. Based on this logic, Ives has made a prediction that many see as extremely bold. By 2026, Microsoft's stock price will exceed $600. Why 2026? This involves a critical survival path issue. Faced with a supply-to-demand ratio for NVIDIA chips as high as 12-to-1, that 97% of traditional enterprises face a brutal reality. They can't get the chips, computing power is too expensive, and building their own AI is cost-prohibitive. In this situation, there is only one realistic, low-cost path: leaning on the giants. These companies will directly use the platforms that have already secured the chips, built the data centers, and are already integrated into their systems. This is why Microsoft's reservoir of customers is so vital. While new AI startups are knocking on doors around the world looking for customers, Microsoft only needs to look at its own backyard. The vast majority of traditional enterprises are already deep Azure users, and their desks are already running Microsoft 365. For a law firm, the most natural move isn't to sign up with a new AI startup. It's to simply click that familiar Copilot button inside the Word interface they've used for over a decade. This home field advantage makes Microsoft more than just a software company. It makes them the AI infrastructure provider for that 97%. If we compare this AI revolution to a 9-inning baseball game, I've noticed that many investors are anxious because they are trying to settle the score in the first inning. Ives believes we are only in the third inning. 2023 and 2024 were the hype years driven by concepts, while 2025 will be the infrastructure year of massive construction. Right now, the stars aren't the gold miners, but the shovel sellers. NVIDIA selling chips, TSMC manufacturing them, Supermicro assembling servers, and even power and cooling companies are making a fortune. This is when Wall Street skeptics ask, we've dropped tens of billions on GPUs, but have we actually made a dime back? Regarding this anxiety, I strongly agree with one of Ives' core judgments. 2026 will be the true year of monetization. By then, the market's focus will undergo a critical shift from how much have you invested to how much are you earning. AI will make a stunning leap in identity, moving from a cash-burning cost center to a profit engine that boosts gross margins. Ives predicts that over the next 3 to 4 years, total global spending in the AI sector will reach a staggering $3 to $4 trillion. This capital will permeate every industry like capillaries, translating into software subscriptions, API fees, and actual cash saved by that 97% of traditional enterprises through efficiency gains. In this process, another often misunderstood giant, Oracle, is undergoing a high-profile rebranding. To many veteran investors, Oracle might seem like a retirement home company living off legacy database maintenance fees. But interestingly, data shows that due to Oracle's unique position in the AI tech stack, its order backlog is growing at a staggering rate. The essence of AI is data processing, and a huge portion of the world's most core and sensitive enterprise data sits right inside Oracle's databases. Oracle's strategy is now crystal clear. It's not just providing cloud computing power. More importantly, it's integrating AI capabilities directly into the core of its databases. Wall Street's current growth forecasts for Oracle are very conservative, at around 15% to 17%, but through his research, Ives found that its revenue growth could accelerate to 30% or even hit 45% by 2026. When a software giant of this scale shows a growth rate of over 40%, its valuation framework undergoes a fundamental reconstruction. This is why Ives predicts Oracle's stock has potential above $250, representing significant upside from its current level of around $195. Of course, as an independent observer, I must also remind everyone to maintain a level of objective calm. We have to wonder, can that remaining 97% of enterprises really integrate AI as smoothly as expected? Technological revolutions never happen overnight. From the birth of the web browser in 1995 to the point where the internet truly transformed business in 2005, there was a decade-long trough of disillusionment. The challenges AI faces are still immense. Take power supply, for instance. The thirst for electricity in data centers has reached near-insane levels. Whether energy infrastructure can keep up will directly determine if the 2026 monetization process will be delayed by hardware bottlenecks. If the implementation falls short of expectations, we could face a sharp valuation correction. However, I find that, when looking at the long cycles of history, such volatility is often just a small ripple in a massive trend. I'd like to use a powerful analogy. In 1882, when Thomas Edison's first light bulb flickered to life at the Pearl Street station in New York, the newspapers of the time were filled with skepticism. Some said electricity was too dangerous, others said gas lamps were good enough. At that time, fewer than 1% of American households had electricity. If you had judged the future of electricity based solely on the financial statements of that year, you wouldn't just have been right in the short term, you would have seemed very rational. After all, it was an era of immature technology, massive infrastructure costs, and distant returns. But unfortunately, you would have won the logic of that year's earnings report only to lose out on an entire century. In 2026, we stand at a similar historical crossroads. Wall Street's current, cognitive sluggishness may be precisely the opportunity left for those long-term thinkers who can see through short-term volatility. It's like a long marathon. Most of the crowd only cheers at the starting line and the finish line, but very few study the runners breathing rhythm in the middle of the race. By breaking down Microsoft's cloud acceleration data and Oracle's order backlog, we can already hear the low rumble of that tsunami in the deep ocean. Thank you for listening to this episode. We aren't just discussing stocks and valuations. We're discussing how to identify undervalued truths in an era of massive change. Just as Edison's light bulb eventually illuminated the entire world, the AI monetization wave of 2026 may reshape our business landscape in an equally irreversible way. Finally, I'd like to close with a quote from Ives. When the masses start entering the market in a panic, if you're still sitting in the audience, that might be the biggest risk of all. We'll see you in the next episode. Make sure to hit that like button and subscribe for more updates. Feel free to leave a comment. I'm looking forward to connecting with you. Until next time.